Hello and welcome to Business Today Television. You are watching Easynomics. I'm Siddharth Zarabi, and with me today, noted economist Radhika Rao, ED and Senior Economist at DBS Bank, Rumki Majumdar. She's the economist at Deloitte, and what we're going to do today on the show is to dive into the latest GDP numbers that are set to be released in minutes from now by the National Statistical Office, an announcement that comes at a time when we are already talking about the impact that Trump's tariffs will have on India's GDP. But before we continue, Radhika, your first expectation numbers that you could share with our guests.
Hi, certainly a lot of anticipation for this GDP number, though it's quite backward looking. It's in April to June. We expect growth to be around 6.6%, so not far from consensus. And I think the major drivers will be more important to watch. I think there you will find three big takeaways. You'll find that the front loading of exports, front loading of government spending, and rural demand, slash agricultural output, I think will likely come on top in terms of supporting growth. And I think some of these factors are not likely to have a redo in the second half of the year. And I think that's where the bigger discussion will come in terms of where the growth drivers are going to come from. But this is how we expect the lay of the numbers to be. And I think the most important there would be that the government spending, which did not do well last year because of elections, is likely to, be one of the major catalysts for growth, especially if the global environment gets very, unfavorable. Then I think we'll have to have domestic anchors that will have to drive growth this year.
Absolutely, and domestic anchors is what everyone is looking towards, because regardless of any thaw with the US, that will take time to pan out. Rumki, coming to you, and we'll bring up the chart, that the poll that we have done, because we heard the DBS number. Rumki, what are the numbers that you are working with?
Hi, Siddharth. Yes, we are also optimistic. We are hoping this quarter would be around 6.6, 6.7%. In fact, we are pinning this quarter to be one of the better quarters of the year, because we saw some of the consumption factors, variables doing really well. The Retail Association of India has reported a very strong growth. FMCG growth has been very strong. So most likely, if consumption, we are expecting consumption to be quite strong this quarter. And if that be the case, then the government's tax exemption policy probably has started working off, and that's something which we'll probably figure out this quarter. We are expecting the GFCF, the capital formation, to be strong, because the Capex by government has been very strong. 24% of the budget, allocated budget this year, compared to 16% last year. Of course, last year was an election quarter as well. So we are hoping that on YOY, GFCF will probably be stronger this quarter. Agriculture, again, we're expecting a good normal monsoon, so agriculture output will be good. So farm income will be stronger, again, boost to the rural demand. So consumption, investments, we are expecting strong growth. So all this should take the growth numbers to 6.6, 6.7 somewhere this quarter.
Okay. Madhavi Arora, Chief Economist at Emkay Global, is also with us. Madhavi, coming to you, what are your expectations as far as that big number is concerned?
Hi, Siddharth. So we're expecting this quarter to be, as Rumki was mentioning, probably the best quarter for the year. There is a lot that has happened which could probably make it look statistically much better. One is the extremely soft deflator effect, which will probably push the services part of GDP, optically much better. Apart from that, we also are seeing a front-loaded spending by the government of India, both on revenue expenditure and capital expenditure, versus last year, because last year large part of the spending was backloaded. So that also, of course, would help this particular quarter. Apart from the fact that we would also see the front loading of exports to the US play out in this in the first quarter of FY26. So all those factors could probably give a temporary boost to the GDP print, which could even touch a 7%. I wouldn't be too surprised if that is the case.
Okay, and we count down to the numbers which are expected any time now. Moving on from the macro for a quick bit, it's very clear that as far as our overall approach towards Okay, we have the numbers. April, June GDP 7.8%. Breaking news. India's GDP growth in the first quarter at a whopping 7.8% versus 6.5% a year ago. Pretty fastest. I can say that amongst the fastest to report this and bring this number on the screen. 7.8% versus 6.5%. I'll go across the panel quickly. Radhika, to you first for quick 10-second observations.
Well, that's certainly a very, very strong number, eye-catching number at that. GVA seems to be around 7.6. So that's also a very strong number, almost 100 basis points, or more than 1% compared to where the consensus expectations were. I think it's
and pretty much everyone, no one expected it. Let's bring that chart back up. No one expected anything close to this. Some breakdown numbers before I go to Rumki and Madhavi. Agri growth 3.7 versus 1.5. Mining sector down 3.1, declining to minus 3.1 versus 6.6. So that's a big worry. Manufacturing at 7.7 versus 7.6. Construction at 7.6 versus 10.1. Services growth at 9.3 versus 6.8. Private consumption growth at 7 versus 8.3. Those are the numbers. Government consumption expenditure growth, our economists dwelt on that, 7.4% versus a minus 0.3%. I repeat that number, 7.4% of government consumption expenditure growth versus minus 0.3. So those are some of the numbers. And gross fixed capital formation, GFCF growth at 7.8 versus 6.7%. So at 7.8%, India saw the highest GDP growth in 5 quarters. Rumki, quick reactions.
Yeah, very positive news, and I'm sure this will be a celebration for everyone out here who have been doubting that whether Indian economy is slowing down and is going to be a concern. But we again, good news is that the consumption and investments have propped up. That's a good news, and we were hoping these two factors will probably drive growth in this quarter. And of course, manufacturing is very strong. That is another very strong activity that has happened, which and PMI indices were all-time high, 14 years high, which we noticed in June. So clearly, there were quite a few high-frequency data that suggested that this quarter is going to be very strong.
Before I go to Madhavi, one more number to share. The industry sector growth down at 6.3%. versus 8.5%. Viewers, remember, this is YOY, this is not sequential trailing. And Madhavi, your thoughts on these numbers? Very clearly, we are seeing mining, construction down, manufacturing in the same trend line, agriculture doing much better than expected. But that big headline surprise.
So Siddharth, I was just telling you that it could cross 7%, right? Obviously, I also did not expect it to be such higher number, but I told you there are a lot of temporary boost factors which could make it look optically a very good quarter. Apart from the fact that yes, there was government spending which has been front loaded, and the front loading of exports which could start worsening as we get into the next half of the year. But at the same time, the services sector has gotten a boost because of a low deflator effect. And in fact, when you're talking about the companies, if you look at the top line growth, that has been quite, the sales have been quite weak. It's the, the EBITDAs or their corporate value add, which has been, relatively better, partly led by the fact that the input cost was much lower in the last quarter for these companies. But again, the top line sales have been quite disappointing, which again reflect that there's a consumption problem. So I think we'll have to move past this quarter. There will be a lot of noise as we get into the next quarters as well, because you will also see the GST impact play out maybe in second half of the year. You'll also see the tariff impact play out negatively as you get into the next quarter. So I think you will see a very patchy sequential growth story in India. But this quarter is basically an outlier in terms of a lot of factors, and maybe as you get into the next quarters as well, because of the deflator effect, you will see, an optically positive real GDP and GVA growth. But I think you need to see beyond this deflator effect, because there are technical issues in the way India calculates its GDP.
Radhika, before you add to your earlier answer, just to take that point that Madhavi makes and take it forward, if the first quarter saw stocking up on account of anticipated tariff changes, could we imagine that at least for the month of July in Q2, before the tariffs started to actually hit, because remember viewers, tariffs are on landed basis. Is that likely to carry forward, or the point that Madhavi makes that Q2 will have a full impact and Q3 also of the tariff hit before a rebound happens on account of possible and likely GST led consumption growth?
In fact, July numbers, I mean, April to July, the exports to the US was very sharply higher, upwards of 20% when you see the goods exports. So that does show that even into July, you had a tail end of front loading that was still underway. But I think the tariff announcement, the second tranche really came in late July into August. And India's second 25% has only taken place in the late August. So I think the true impact of front loading and passage of the front loading in India's case, I think would be more visible from say September onwards, right around the same time when we will possibly see some GST relief as well. But these are two different growth engines. I think on the GST front, certainly it's a big boost for consumption. But what you would see is that in anticipation of GST cuts, demand ahead of it, which usually comes in the third quarter of the year or second quarter of the fiscal year, will get pushed back by a quarter because you will have some of the purchases that could be put on hold. So I think there is going to be certainly a bit of handholding that's going to go on between the quarters. And the deflator point is also quite important, and I think we haven't seen the end of it. Because we do remember when we went into this quarter, you really seen even further slowdown in terms of inflationary pressures, which are yet to show. And I would be keen to see where the nominal GDP is as well. Basis is 7.8, it does look like nominal GDP might have slowed and could be in the 8% handle. So that has further repercussions for the economy when you talk about tax collection, when you talk about corporate results as well. So certainly we need to get a holistic picture, but at the headline level, especially for real GDP, certainly what was expected was a slowdown from the March quarter. Instead, we got handed over a much stronger growth pace. And
Radhika, are you comfortable at this stage to give us your latest thoughts on the full year number?
Certainly, I think our number that's going to be a tricky one because we had a sub-consensus 6.3% growth real GDP. Now this 7.8 certainly puts into view. We still expect slowdown in the next 3 quarters. But even then, I think 6.3 from just this first quarter point of view looks quite low. So I think we will have to relook at the numbers, and perhaps we could see at least 30 to 40 basis point increase in our base assumption. But that doesn't take away the fact that, again, trend-wise, we have perhaps at the very peak one more quarter of a stronger print, and thereafter we would see moderation. That was what our trend growth looks like.
Rumki, that very same question to you. Is this going to sustain beyond maybe half of Q2?
So we were expecting 6.6%, but of course this quarter being 7.8, so we really need to relook at it. We expect the second quarter will be a little slower because one, monsoon related will probably have some disruption effect on the construction activities and others, and manufacturing as well. Plus the tariffs impact, all these will have an impact on exports. So second quarter might be slower. Third quarter might be moderate because it's a festive season plus GST effect. Both will start over offsetting the impact of lower exports. Fourth quarter is when we expect that the growth will again turn around. So first and fourth quarter will be probably the driver of this entire year, with the third quarter being more or less better. But second quarter will be probably tough. But we have to keep in mind that last year for second quarter was 5.6%. So low base effect might actually help the second quarter of this year.
Madhavi, I take that same question to you as well. What does this mean for the full year? What kind of numbers will you be able to talk about right now?
Siddharth, we'll have to see the numbers. Too early to really change the forecast. We were at around 6% to start the year, much lower than the street. And we've been sort of talking about the absence of private economic agents in the economy. And now we have, the new hits in the form of probably, punitive tariff tax on India, which probably could stay for this year altogether. And would further weigh down on the 6% numbers that we are seeing at this point in time. But again, as I said, there are a lot of moving parts and some artificial boost, which probably could, make the numbers look different from what we had forecast. We'll have to look into the details and see, how things pan out. But I agree with the panelists that this is the best that we have seen for the year in terms of our quarterly prints. And most likely going ahead, we will be seeing much lower GDP growth print. But because of softer deflated effect, I think the headline would still be probably, hugging close to 6% plus into the further quarters as well.
Radhika, I want to take a broader sort of look ahead question with you, but before that, I'm just wondering what seems to have happened as far as mining is concerned or construction is concerned. Is there something that we've kind of missed in our understanding?
Sorry, I missed the construction numbers. I haven't seen the
The
breakdown.
construction is 7.6 versus 10.6, and mining minus 3.1 versus 6.6 a year ago. So I'm just wondering what seems to could have happened here.
Certainly, we will have to look into the numbers, but we had expected, in fact, construction to do well. Because we had seen a pickup in government spending, steel, cement sales were also looking good. Some of the construction project that was stalled last year could have been resumed this year. So this certainly comes at a bit of a surprise. Perhaps there is something at the states level that has, slowed down. That those could be some of the factors. Mining as well. I mean, ahead of the monsoon period, usually you see a pickup in activity. That's also slightly counterintuitive. So I would partly put it to base effects, partly we will have to see what the other drivers have been, which seems to have
Absolutely. And when I look at the IIP numbers, very clearly mining both June and July down pretty significantly, and that perhaps is the story. Radhika, again back to you on the impact that you see. Roughly 60% of India's exports to the United States now tariffed at 50%, 40% or thereabouts still not tariffed because they are exempt categories, although we don't know what could happen to pharma given the latest threats that have emanated. What's your sense? How much of an offset will our export engine be able to achieve, and what realistic decline do you yourself estimate on account of these tariffs?
So at the current juncture where we have about 60% or 65% of the basket under the tariff, so our forecast is that could be about 40 to 60 basis point impact on growth because of this engine. But like I said at the very start, there are really the domestic anchors that are kind of pulling the growth card. So there are ample, I think, at this point, and given this very strong number in the first quarter of the year, you've actually have enough offsets to kind of not bring that completely into view. But I would think that, and the additional point that I want to bring out is that the exceptions, we do think that the exceptions are not going to be exceptions any too long. In fact, we do think that semiconductors and electronics, for example, already had part announcement of about 100%, but there was no there was no further information on when the implementation could be. So I would think it's a matter of time before the other segments also come into the purview. But at this point, I would say 40 to 60 basis points is what we are expected. I think half of it could be, offset by what's happening domestically, especially on the GST front.
Okay, thanks very much, Radhika, for your time with us today. Rumki, let's focus on the practical upside that we could see on account of GST. What kind of scenario do you think is likely to pan out? Although I must caution at this stage that while Business Today, and you have almost like a dozen stories up there on our website which give minute details of sectoral proposals by the group of ministers, which will be discussed on the 3rd, 4th and 5th of September by the GST Council. So pending finalization, it's very clear that there are steep cuts on many items and there will be increases in at least a dozen items. Given that backdrop and the information that you would have, Rumki, what's your own estimate about the economic impact that we could see, the positive impact on account of this GST bonanza?
There will be two direct impacts for sure. One is to the consumption in itself. It will probably result in higher consumption, especially for the goods which were earlier in the 18% basket, which will now probably will be in the 5% basket. So that's one. Second would be is the cost of production, because a lot of intermediate costs, etc., will probably be now lower in prices, and the producers might be able to pass on those low cost of production to the consumer. So inflation will probably also be lower because of the GST. So these two will definitely help. And given that the challenge where it could be is the revenue collections, because this is probably could have an impact on how much revenue the government will have to forego, given that the government is already compromising a lot on revenue because of the tax exemptions. So we have to see how the fiscal deficit will pan out. I'm sure the government will adhere to the fiscal consolidation path, but the risks will remain. But overall, it's a bet the government is taking on boosting the domestic demand.
Okay, domestic demand to offset external headwinds. Is that a serious enough scenario, or do you believe that you can't simply look towards a direct correlation and replacement in this scenario, Madhvi?
Siddharth, it seems pretty coincidental that these two proposals, one is the tariff impact and the other being the GST, play on taxation, have sort of, been at this around the same time. I don't think that the policymakers are necessarily planning to bring it out around the tariff imposition period. I think, and to the extent that there would be a tariff-led hit to the economy, which could be as high as 50 bips to GDP. I think the GST cut impact would, on net, depend on the net fiscal impulse that the policymakers are given to the economy, because the net impact in aggregate growth will essentially be a function of the net fiscal impulse and not just the GST effect. If the policymakers are reducing their capex and revenue expenditure outlays to match their fiscal deficit number eventually, there would be net zero additional fiscal impulse that the economy will enjoy. So I would not then think of it as any additional benefit per se. So we'll have to see what the actual net impact of fiscal impulse is going to be on the GDP growth from the policymakers' point of view.
Okay.
Yeah. And of course, the tariff-led impact is something which we'll have to see how it pans out. But as far as our understanding is concerned, the annualized hit to growth could be as high as 50 to 60 bips if these punitive taxes by the US continue.
Okay. And you said 50 to 60 basis points. Let me just also add some more color in terms of information to that big surprise number that we can see, and this is capital expenditure data that we have for the April-July quarter. You have some visuals on the screen of Prime Minister Narendra Modi, who is currently in Japan, and very clearly this is part of the formal engagement where MOUs, agreements, documents are signed. So with Japan, India's economic relationship goes back many decades, and one of the most reliable, sturdy partners as far as India is concerned, both on a direct investment basis as well as very significant corporate investments. But let's look at some of these numbers. Capital expenditure in the 4-month period beginning April is at 3,46,900 odd crore versus 2,61,300 crore in the same period a year ago. Non-tax revenues are up almost 25% in this same period, and if we see gross tax devolution is on the same scale, the fiscal deficit is higher by around 10% percentage points, and total receipts are lower than the same period last year. Total expenditure more or less on the same lines as previously. If we look at gross tax revenue for the center for the month of July, more or less the same as last year. Non-tax revenue doing much better, and capital expenditure overall for the month of July lower than the same month last year. So clearly some other data seems to suggest that the first quarter boost that we saw reflecting in some of these numbers. Rumki, I'm coming to you for your understanding of how inflation will pan out going forward, because the RBI will be looking at these numbers. It will also look at its own way of both looking at economic growth and the price situation. What's your own reading of inflation at this point of time?
So we are expecting inflation to remain contained for at least the next few months, because one, good agriculture output means you will have food prices under control. Oil prices will probably remain range bound. Of course, it will be volatile, but it will be range bound. So both these probably will keep the overall inflation lower. Where it could be a challenge is if there is an inflation in the US, that might result in higher imported inflation into the country. The second risk is if the demand starts growing because of higher disposable income, because of tax exemptions, GST cuts, all this will probably result in higher demand. And if investments, especially private investments, doesn't pick up, then there could be a demand supply mismatch, and that could result in overheating of the economy. So the core inflation could possibly be going up, and it's already been trending up in the last few months. But that said, we expect inflation to be below 4% or around 4% this fiscal year entirely. So at least for the next 8 months, we expect inflation to be much more controlled and much more tamed.
Okay. Madhavi, as we wind down this conversation, I want you to also weigh in on the inflation outlook as you see it.
So Siddharth, we're looking at inflation close to as low as 3.1, 3.2% for the whole year, and it could even surprise further down. For WPI inflation, we are in the next few quarters we are looking at it to remain a negative territory. So for the whole year, I think the overall deflator, which matters for the economy, would be as low as 1.2% of growth that you would see, which essentially means that your nominal GDP could also remain very sticky at around 7.5%. And as somebody was mentioning on the group that a lower nominal GDP essentially would have implication with regard to corporate earnings, with regard to debt dynamic, with regard to even the all of these macro parameters that we track, be it current account, be it fiscal, and all of that. And eventually, somewhere will feed into the fact that there is, apart from the noise that we are hearing with regard to the statistical boost and things here and there is a genuine slowdown that is also reflected in the fact that the core inflation has been steadily coming down over the last 2 or 3 years. And that actually needs to be seen in a much more holistic fashion, because a lower deflator also is not necessarily good for the economy, for the corporate sector, and probably good for consumption boost, but on net essentially is not a very good stimulator as far as production side of the economy is concerned.
Madhavi, just a quick one. In terms of this latest data and the RBI's approach, given what you said about inflation and what RBI has spoken about, what do you think is likely to be the course for monetary policy?
So that we are looking at policymakers being relatively much more easier as you get into the few quarters ahead, because there is going to be a disinflationary effect which will play out around Asia, given the excess supply that the Asian subcontinent specifically is sitting with, and maybe America would see a much higher inflation because of the tariff hit. But I think in Asia, the growth effect, as well as the fact that there will be a excess supply that most of Asia would be faced with, there is going to be a disinflationary impulse which will play out. But domestically as well, Of course, we'd seen the best of inflation numbers in the last month, which was at around 1.5%. Even going forward, few quarters you will see inflations, or few months you will see inflation still somewhere sub 3%. And overall, the threat of inflation in terms of headline numbers doesn't look to be very, ominous to me. In the first place, and in fact, WPI inflation, which is the input cost inflation, has already turned negative, and I think few months, you will see the negative trend to continue because of the base effect. So I think net, yeah, inflation story is something which RBI could also see it as a positive play as far as their reaction function is concerned. So my sense is that come December, you should see 50 bips of rate cuts, or by end of this fiscal year, you should see 50 bips of rate cuts from the Reserve Bank of India.
Rumki, very clearly a big surprise, 5-quarter high, and we do understand the reasons. But looking ahead, and for our viewers to understand, look at this year. We started the financial year with the income tax cut. We are going to shortly have a massive GST cut, and in between that, we have had 100 basis points reduction in the interest rate. Is that likely to pan out further, maybe 25-50 basis points, or stand still for now, given the uncertainty around what will happen due to the tariff impact?
So the RBI probably has paused for a reason, because it probably wants to understand how the global uncertainty pans out. But I think by November, it will probably be more or less clear which direction we go to, and then and RBI might go for a 25 to 50 basis points rate cut by this end of fiscal year. But that is max probably it will go to, given that if inflation goes up in the US, then the Fed rate also may not go down as much, and then probably they might also raise the policy rates there. So we'll see how those dynamics actually move. But maximum, we are also penciling 50 basis points rate cut by the RBI by the end of this fiscal year. But there will be a pause in between, so that it can understand how this whole tariff dynamics play out. And if you're able to come up with a trade deal with the US by October and November, then I think a lot of those uncertainties will probably be taken care of.
Okay, viewers, so a very big surprise as far as the GDP numbers are concerned, but there was a sense on the street that there is stocking up happening ahead of Trump's tariffs, and that seems to have panned out. Some of it likely to continue, according to our expert economists on the show today. But I want to end by another major news announcement today. Not a surprise, had been expected for months now, and that is a big bang IPO that Reliance Industries chairman Mukesh Dhirubhai Ambani has announced today for Jio, India's largest telecom network, and by reckoning the second largest globally, is now preparing for a public listing, which Mr. Ambani said would likely happen in the first half of 2026. How massive will that issue be? What will it mean for our markets? Remember, the other major telecom stock that has been listed now for many years, almost 20 years plus, 22, is Bharti Airtel, and you've seen that stock and its performance, if you can try and bring that up. But the big one will be Jio, and the Jio IPO announcement comes alongside many other announcements that are typical of Reliance AGMs. There you have it, the Bharti Airtel stock on the screen today, up barely just 0.5%, but RIL ending down 2%, perhaps some amount of profit booking. Remember, it's Friday that happened, but clearly for the markets, the big announcement today is the Jio IPO, and that will pan out over the next few quarters. The overhang as far as Trump's tariffs are concerned and the uncertainty that it has unleashed weighing on the broader indices as the markets closed for the week. With that, I'm going to thank all my guests, Rumki and Madhavi, for staying on this special show of Easynomics, where we decoded the latest GDP growth data, a 5-quarter high at 7.8%. Will it continue? Will it sustain? That's the big question, for which answers are expected only in the months ahead. With that, it's a wrap on this show. We'll come back with more. Until then, goodbye.
Hello and welcome. You're watching